Good morning, traders. Today is August 21st, Sunday. We're going to go over the markets today. I'm going to keep you updated. Try not to keep this too long. We've got a lot of data to go over, and I want to try to show you my new real estate market metrics data that I'm going to start posting every week to everyone so we can follow what's going on in the real estate market, help us gauge our investments. Kind of a big shift in the market right now. Capital is searching out strong earnings, possible dividends. It's shifting away from speculation. FANGs look like they're about ready to fall again. The U.S. stock market may move downward. I'm starting here with a weekly SPY chart. And what I want to point out, let me spread this out a little bit and share with you the setup. We've got a big stalling pattern across these highs from the peak back here in January to the peak here in the end of March, coming across those highs. You can see we've danced around that level right here and fell late last week very strongly around this resistance zone. We could move back down to this level fairly aggressively, tightening out through an excess phase peak. An excess phase peak typically moves into a rally phase, which we saw here, rolls down to find some support, rallies back up out of that, breaks downward, and then eventually rolls to the downside. Now, there's two things that are very important here. Number one, this channel here, which was the January, February, March channel that rallied upward, this was very important for an excess phase peak. We need to see this channel happen. Then we establish some level of support across here. Try to draw a little deeper. Now we're in kind of this bounce phase. And this bounce phase may roll over in this resistance channel here, potentially rolling back down into an extended sideways downward weakening trend, and then eventually weaken into longer term cycle trending. So understand that we're very much playing out into this excess phase peak pattern. It looks very common right now to everything that we've seen in Bitcoin and other previous market tops. This is a very standard pattern. I call it phase one to a peak, phase two to intermediate support. Then we need to get this upward flagging formation, this channel that breaks downward to immediate support. Once we get immediate support, then we start to move into this. It's like a recovery rally, but it fails. And eventually it'll roll back over, maybe many weeks or months before we break downward. It could be, just a few months. It could be 6, 10, 12 months. It's been that long before. But eventually this rolls into deeper downward trending to try to establish a new eventual low somewhere down in this point. So this is the broader cycle trend that we're in. I want to warn you, though, that this peaking pattern right here could become fairly dangerous. And when I say fairly dangerous, I want to point out here that we have bounced around this 382 level, this red line level here for support, come back up here into this 25% level, this green line here. And then I want you to realize, ladies and gentlemen, that we could very easily roll back down here, eventually target this 50% level, and move back down to this 618 level, eventually over the longer term. So capital is shifting. It's moving away from speculative trades. You saw the meme stocks rally, and they failed fairly quickly. There's a very big issue right now with sustainability, long-term profits, and what consumers are going to be doing when they tighten up their belts. So we could have a very big unwinding phase here, 6, 7, 8 months of congestion, and real smart money is moving away from speculative trends and into more solid earnings. Certain companies like Microsoft may be a good solid company, Amazon probably a good solid company, Tesla maybe. But I read an article now that GM, Ford, others, T-Mobile, I read an article that T-Mobile is doing quite well. I think you're going to find quite a big shift in what was the innovative high flyers of 6 months ago turn into the non-performers over the next 12 to 24 months, maybe longer. as the market shifts into more industrial earnings, dividend type companies. Utilities will probably do well. Technology service companies like T-Mobile probably do well. Other sectors servicing like AutoZone probably do well. Things like that are really going to be the big shift going forward. So now let's go ahead and take a look at the charts. First, I guess we will start with the gauges. The NQ danced around turning positive on the weekly and daily last week. It didn't do it. It did briefly on Tuesday, Wednesday near the peaks, but then failed as of Friday. I'll show that to you. So nothing has changed with regards to our trending system. The ESYM, Dow Jones Industrial Transportation Index, and SPY are all bullish. The NASDAQ is bearish, which is, again, giving you a warning here that we're likely shifting into an extended unwinding phase. Gold and silver are still on the modeling system bearish. I think that this is kind of a broad unwinding phase. I think that gold and silver overall are holding up quite well, but trend-wise, they're in a downtrend, and we're waiting for that big recovery to take place. Oil is mixed, short-term bearish, long-term bullish. I really believe oil is going to move down into the $74, $72 range, maybe a bit lower, but time will tell. Really, time will tell. Right now, the modeling system stayed bearish on the NQ this week. It moved briefly bullish into bullish trending on Tuesday, but rolled back into bearish. This tells me that the markets are kind of failing. I believe the markets are going to roll around over the next 5+ days before attempting to trend downward. Time will tell. Today, nothing changes regarding our allocations and trends. We need to stay very cautious still. Watch this video. The point again, ladies and gentlemen, last week I told you that we were going to incrementally move into stocks as we had this trigger. I think that we're seeing a big unwinding phase, and we're not done with it yet. So I am kind of taking control of how I'm handling my own investments, not jumping into an over-aggressive bullish trend while the NASDAQ stays bearish. The other markets have turned bullish. Trying to advise you to take a similar stance, protecting yourself against risk, downside risk. And like I said, we're getting very mixed triggers in the market. I'm waiting for some sort of contagion, some debt issue or war or other issues to play out. I'm watching China, as you're well aware. I think China and Asia are the next big global financial crisis that are setting up. I think the U.S. market may do fairly well, but it'll be drugged lower as the global markets decline. So understand that I'm keeping everybody very, very cautious right now. Even though there's opportunities in certain stocks, we need to stay very cautious. This is not the time to be getting all in on a bullish trend. I'm reading hedge funds are doing it. Others are doing it, taking an aggressive stance. They may watch a 15 or 20% decline take place over the next 12 to 24 months before the markets really find a bottom. Now, let me show you this one chart, this one, that really paints a clear picture, okay? This is 2015 bottom up to the 2020-21 peak. Understand the global markets rolled over in the middle of 2021. The U.S. markets did not. And this shows us that we've seen a very clear rally up to this wave 5, and now we're in an A, B, C correction, potentially moving downward. This is a monthly chart, ladies and gentlemen, and ideally, this downward cycle phase could move to the end of or the bottom here of 2015 before stalling. So we have potentially another 25-30% downside move, and I believe this A move is just the beginning. The B move is retraced to 50% already. It could attempt to move to this 618 level. I've drawn a line here, and then it could fail and move sharply back to the downside. When I say sharply back to the downside, I'm talking about 2018 lows. Okay, so we need to pay attention to this wave 2 area here and this consolidation here around COVID. We're nowhere near these COVID lows. We could easily move back down into these COVID lows here, or this 2018 low, which was, remember, December 24th, if I remember right, 2018 was the bottom. I'll show you this on the charts. But this is a very clear picture of where we're at. When this counts a wave 5 here, this is really, believe it or not, ladies and gentlemen, this is really a wave 4 move going all the way back to 2010. So this constitutes, wave 3. This constitutes a wave 3 completed 5-wave structure. We're now in a wave 4 correction, and I believe it's got to get down to these lows or down near these lows here before we're going to go ahead and see this actually stall out. So we are going to come back to the FANGs index. FANGs index paints a very clear picture. We do not go back to the 2015 level, but we go back to the 2018 lows here that I just showed you, and COVID lows. This shows us that we could see a rollover here back down to the COVID lows, back over into this area, or deeper down to these 2018 level lows. We're really at a period of weakness here. You can almost see the excess phase peak very clearly. We're finding support right now around this 618 level and 50 level right here, but it stalled out last week. Very clearly, I think we're going to start to see a rollover, a moderate rollover. Remember, it may be fairly aggressive, but in reality, I think it's going to be just a very slow unwinding of data in the U.S. for the next 4 to 6 months through the end of this year, and then start to accelerate in 2023, possibly to the downside. So we've got a very clear warning. You can almost see a very solid line right across these highs, coming straight down right across here as a deeper trend. Now, we could get above that. We could still move higher, so I want to let you know that even though my interpretation is that weakness is likely ahead of us, we could still attempt to move a little bit higher in this channel before it rolls back over. In my opinion, the markets will eventually roll over into a downtrend. So be aware that this uptrend is really kind of a dead cat bounce in a end of an excess phase peak. The U.S. stock market index here shows a very clear picture again right across these highs. You can see that we're reaching this price amplitude arc here. Very nice solid bounce. You can see we've had a little divergence across the stochastics range here. It looks to me, like I said, like the buying pressure here is waning. We saw this very strongly last week. I think we could see a rollover, quite an aggressive move back down here to 1,000, kind of retesting these levels. But ultimately, ladies and gentlemen, the area that I drew back over here in the red zone is where I think we need to come to ultimately try to find some support. So we need to pay attention to that. That matches the 2018 lows, the COVID midpoint area. This trend line that I drew, this red trend line here, this is ultimately where I think we need to come to try to find support in the U.S. markets. So we need to stay cautious. That's what I'm really telling you in this update. The Smart Class Global Index has started a nice solid downward move. You can see it's gotten a little more aggressive across these highs here. It rolled over last week, stayed very bearish. Global markets are really contracting much stronger than the U.S. markets. That's because foreign investors are trying to pour money into the U.S. markets and the U.S. dollar while it stays strong. This could break out into a new downtrend, which could drive global assets even weaker. Could present a very big fear, a trend of fear moving into the markets over the next couple of weeks. The metals index rolled downward again last week. This shows that general fear is filling the markets. Metals should be moving higher. They're holding up actually quite well in the overall scope of things. We've come off of our highs, obviously. We've got this quadruple bottom, may come down and retest it again back in this area. But this is, again, another selling pressure in the global markets. We're likely to see this 375 roughly area hold. Metals are likely to try to find some support. They could come down and retest a deeper low, kind of like what happened over here with COVID. So we could briefly come down into this 360, 370 area. This was the 385, 390 area. But we could come down in this 360, 370 area. This is what I would be considering a very deep washout low in metals. Overall, metals are holding up quite well, though. And like I said, I'm loving the opportunity to buy more physical down in these lower price areas. Silver below $17, $18 is really a gift. Next, the valuations index rolled downward. You can see here we have divergence across stochastics. We have a good solid downward trend here. The valuations index will, in my opinion, continue to moderate and roll downward into this 61, 62 area, showing that a broad unwinding is taking place. And like I said, capital is going to start shifting into earnings, dividends, and really solid companies, ones that will survive a recession quite well. So start thinking about opportunities in repair companies, AutoZone, O'Reilly, things that are going to survive an economy where consumers are trying to fix and extend the life of what they have instead of going out and dumping into new equipment. Next, we have the commodity gold index really flagging out here, very, very narrow. And this shows me, again, that we're unwinding commodities and gold is holding up quite well. Commodities will likely continue to deflate, which is good. We're going to see lack of demand. We're going to see a real tightening going on overall with regards to commodities. I do not see central banks being able to spark much in terms of reflation. I think consumers are really very cautious right now, and commodities will continue to weaken and tighten, which will push this back down into this lower channel again, kind of like we saw back over here. This is COVID. This was the 2018 lows. We need to see this really move down into this red channel here to see kind of a washout. And it may stay down there for many weeks or many months. So pay attention. You can see the commodity gold index moved down 18% last week, almost 19. It's really weakening. Things are tightening up very quickly right now. The volatility index, which I warned above this magenta level last week, could have been a very major top. We don't have any confirmation of this yet. We do have a rollover in stochastics. We do have weakening RSI. I'm expecting this to roll back down here around 6.5 to 7. Understand that that would be a broad market decline. Could still be moderate in scope and size, like I told you, but we need to kind of see this consolidate back down into this area. I think that's what's next. If we get much above this level without any real impetus of consumer spending and high inflation, this is just speculation, in my opinion. Next, okay, we're at the end of this one. So now we move to the real estate trends. And I'm going to show you something here in a minute that shows even more real estate trends. Real estate's pausing right now. Interest rates have come down. You can see here we've got the reduction count is coming down. That's because they're basically sellers are not willing to reduce prices. They want to see if they can get the best price that they can. Price levels are still dropping a bit. So you're seeing still reductions, but not the same level of reductions. You're seeing active listing counts stalling. You're seeing price reduction share continuing to stay positive, but stalling a little bit. And you're seeing days on market continue to climb higher. That's this gray line. What this means is it's generally weakening. Think of it as the boat is taking on water. Nobody's really bailing out the boat. It's comfortable. We can handle the amount of water we're taking on right now. There will be a broad market impetus change or impulse change when the Fed likely raises interest rates again, and this may drive prices a bit lower, interest rates higher. But right now, the real estate market is kind of just stalled out. It's not really doing much. The one thing I will tell you that it is doing is you're seeing active listings come down. People are pulling listings off the market. You're seeing days on market rally up. You're seeing prices come down. You're seeing median listing price come down. Price reduction share is going up. That's this light blue line right here. So it's basically stalling in a reduced price format. And that tells me that buyers are just not engaging. And that's why active listings are coming down. People are pulling off the market, maybe waiting a week or two or three, and then putting it back on the market. Next, we have the volume ratio index, custom volume ratio index. We had a good bout of buying over the last couple of weeks. That's what these big triggers were. Now I'm watching out for a big breakdown. We could see a breakdown in volume take place over the next 3 to 4 weeks. That would indicate that we've seen a big shift in the market dynamics. You can see we lost almost all of our buying pressure advantage last week with this negative 0.98 or 98%. That's where we get this level here. We basically lost all of our buying impulse last week. So right now the markets are very, very flat, very toppy, and we could see this change dramatically. We could see a downward trend take place. We've seen this buying take place right over here, started to really change direction back over in this area. I think we're a couple of weeks away from a big breakdown, okay? Next, we have the U.S. to valuation trend index. This is one of my favorite, starting to become one of my favorite charts. And this is a monthly chart, ladies and gentlemen. It is inverted. I forgot to change the color. It looks like, but we will still go forward. So this is a downward bar here. You can see it's white here, but it's actually a black bar if I change the colors. We are seeing this downward trend. This is a very good indication of an A, B, C wave. Now we might be looking at a D wave here, followed by an E wave back down over here. We see solid downward trending, solid downward trending. Nothing has really changed. We are in a new weakening trend. And you can see we have this trend here from 2016 into roughly 2018 when we had this big rally phase. Then we had this extended rotation here. This is showing us that we're in an extended downtrend. Now, what's different between all of this? The Fed. The Fed started producing a QE stance back down over here in 2010. We had these rally phases, and each of these declines are typically around areas either centered around elections or QE tightening, so quantitative tightening. Now we've gotten into the end of an excess phase peak. We're into a tightening phase here. We're into an unwinding phase, and we need to really watch this. This is the 2018 low that I told you about. This is where we need to pay attention to see what the markets are going to do, and we're still quite a ways away from that. So we need to be very, very cautious right now. The markets are in a broad unwinding phase. Global large cap index is holding up. It is still weakening, but still holding up quite well. Large caps, institutional, Dow Jones institutional, S&P institutional, for example, those that are supplying manufacturers, those that are supplying essential goods, commodities, chemicals, things of this nature, essential goods for the general populace are going to continue to do well, in my opinion. You could still see a 10 or 15% drawdown over the next 5 to 6 months, maybe longer, with regard to the general market decline. But understand, that's the area that we're likely to see continued strength. Utilities, manufacturing, not necessarily general, but large cap manufacturing. First of all, for example, 3M, Johnson & Johnson, Heinz, Kraft, things of this nature, the general consumption items that the general populace will fall back to during a recession. So we could see fairly strong recovery compared to the NASDAQ, compared to speculative stocks in the general large cap index. Next, the U.S. to custom index. So this is showing us that the U.S. market here, and here's a very solid downward trend line, and here's the global market trend line. We've shifted downward in the global markets. We're seeing weakness here. We're seeing moderate weakness here. We could see the U.S. markets attempt to move lower, back down into this upper COVID range. I've highlighted this many times. This becomes our real strong support area here. We've already come down to this level, which is just above these COVID highs. I think we're going to be looking at a new COVID low area here. And I believe the global markets compared to 2017, which is when this starts over here, I think the global markets could turn negative fairly quickly from 2017. That means that we're going to be wiping out 5 years worth of global market growth pretty quickly. So understand that a downturn in the global markets back down to these COVID lows or lower would move the global markets into a zero-sum gain over the last 5 years, while the U.S. market would still be at a 30 to 40% gain. And I'm going to try to keep this anchored at 2017 so we can see. But get ready here, folks. We have a real chance of watching another 20 to 30% decline in the markets, potentially rebounding off of this level or down in this what I would call the 40% level right here. This is a very strong potential over the next 4 to 6 months. Next, we have the Global Asset Index. This is the custom Global Asset Index, holding up quite well, still weakening. Looks like I forgot to change the color here as well, but still weakening. Remember, this is a monthly chart as well. Once we break out of this channel here, ladies and gentlemen, we need to start looking at these lower areas, 2018 areas, and then potentially back down here in 2015-16 areas. So we're looking at a real potential for some decline, but we haven't seen it actually happen yet. So we're in this stalling pattern, which is why I'm telling you we're not seeing any real growth. We're not seeing any real opportunity. There is no broad market advance taking place. We are still in a big unwinding phase. Next, okay, we're done with those. So now let me come here to the TT Scanner Index or Hot List. TT Scanner Hot List has gone pretty much completely flat. Okay, we have these longer term triggers. These are weekly, 27 weeks in XOP bullish. We've hit both targets. And 31 weeks in XLE, we've hit both targets. We are long. We have a stop level here at 65.32. It is currently trading at 79. We have a stop level here at 107.75, currently trading at 142. Otherwise, look at here. Metals and miners have all moved into bearish trending. Otherwise, we have completely flat. We have no new triggers. So that means that energies are still bullish overall on the weekly triggers, and metals and miners are bearish on weekly triggers. These are 5 to 6 weeks old. We've got some decent profit in the trade. We have hit no targets, and this is where we have our stop levels right here. So we're pretty diverse. Metals and miners are weakening, which is a fear-based sell-off in metals and miners. Energy is still overall bullish. Nothing else is generating any real trend. And that tells us we need to stay very, very cautious. We're not seeing any broad market trending whatsoever. We're seeing essentially inflation in energy. We're seeing selling in metals and miners, which is fear in the markets. And we have no other trending taking place. Okay, now let me come over here and here and here. Okay, might be a little hard for you to see. Let me see if I can open this up a little and drag it. So this is my new real estate modeling system, and this is going to become part of what I deliver to you every week. So what we're doing here is modeling price trends, and price trends have moved into downward trending. Kind of hard to see. I'll try to mark this 0 point, but we moved into downward trending. We've been in downward trending basically, ladies and gentlemen, since the beginning of 2022. Overall, price reductions have stayed very, very high. Reductions are nearly 60 to 80, actually 80 to 90% of the general market right now. Although price reduction counts are declining. That's because we are not seeing prices decline as aggressively over the past 3 to 4 weeks, but price reductions still make up 80 to 90% of the general market. Active listings have declined. So we are seeing active listings decline on a week-over-week basis. You can see we've moved into a broadening type of pattern. I believe this is going to start to increase again, but it's going to flatten out. This is a big change. This is COVID 2021 and early 2022, I believe it's going to start flattening out in the positive side. I think active listings are going to start becoming positive. You're going to see reductions continue to share increase. You're going to see price trends move downward and active listings start to move upward again. And then down here we have new listing count metrics. We basically have, let me move this up. We have three core elements here: new count change, and share of market. So share of market ends up being somewhat flat comparatively, but we have new counts are elevated. New count change is actually decreasing. As I mentioned to you over here, it is decreasing. And then actually as a percentage of share of market, new counts make up a very small share of market. Let me come over and take a look here. New counts are making up, share of market is about 2%, 1.2% overall, 1.6% overall. So what we're seeing here, ladies and gentlemen, is a broad selling phase. You're seeing buyers really not engaging in the market, sellers trying to get the best price that they can. And if they're unable to get the price, they're willing to pull the listings off and wait to see what happens. Listings that are staying on the market are being reduced. And you can see that listings are actually being pulled off the market a little bit while prices are declining. This is going to change, in my opinion. Fed's going to likely raise interest rates. You're going to see new listings rally back up. You're going to see reduction prices continue to stay higher. And you're going to see essentially sellers. It's going to be a revamp of 2007 and 8 and 9, where foreclosures and desperate sellers are trapped while buyers are simply not engaging with higher interest rates. Okay, so let's come over to the TradeTank.com charts. Let's start with the ES. You can see the ES is weekly bullish, daily bullish, rolled over. We're going to stay very cautious here. The NASDAQ is, let me get rid of this here, weekly bearish. It briefly went bullish last week, warning of a potential major top. Weekly bearish, daily bearish. The YM is weekly bullish, daily bullish, rolled over again last week. The SPY is weekly bullish, daily bullish. Could be a very strong rollover here. We'll see and pay attention. IYM, which is the Russell, is weekly bearish, daily bearish. Let's take a look at the financial sector. XLF is weekly bullish, daily bearish. Could be a very strong sign here. We just need some sort of downward momentum. Let's take a look at IYT, the transportation index. Weekly bullish, daily bullish. This could be changing. Transportation index typically leads the market, so this is a recovery phase that you can see took place here, and this could be an expectation that November, December could be seeing some sort of a Christmas rally. But because this is normally 3 to 6 months ahead of the market, if this really starts to tank, if transportation starts to move lower, then we're going to be looking at a very weak Christmas season potentially. Gold is weekly bearish, daily bearish. Would love to see gold hold up around the support level again and try to move higher. Silver is weekly bearish, daily bearish. You can see here silver is trying to hold up around $17.90, $18. Would likely come down and retest this level, maybe a bit lower on some extreme global market selling, and think of that as some sort of a contagion crisis event. Crude oil is weekly bullish, daily bearish. It is mixed. It is moving lower. As I mentioned to you, I really think we're going to get down into this $71, $72 area just with continued demand destruction for crude oil. And this is a lot of this is originating from inflation, from global market contagion that's already taking place in China and Asia and parts of Europe. Ideally, like I said, if war or supply is disrupted, we could see it move higher. But if supply continues where it's at and demand destruction continues to take place because of extreme pricing pressures, this is just going to melt downward into this $72, $74 area, maybe back down into this $64, $65 area back here where we saw support. You can see the support level right down in this area could potentially be a real bottom for oil. So we need to see how this plays out. Let's see what else we need to go over. I think that pretty much covers it. I would like to highlight, if we have a little time here, Bitcoin. Bitcoin has really consolidated down into this channel, and you can see I'm playing around with my predictive modeling system here. So let me show you what the predictive modeling system is really showing us. It is telling us that there is a potential for a big breakout rally sometime around, let's see here, what is this? So we're in August. So this would be August. Sorry, I'm trying to see the chart here. This is daily. Okay, so the end of August, end of this month, another 2 weeks away, there is a chance for a rally back up into the 35 to 37,000 area for Bitcoin. I want you to be aware that there is a potential for that. There is also very strong trending for a potential down into the 15,000, maybe down to 10,000 area. Ideally, the most logical outcome for Bitcoin is that we are going to see it trend downward below 20,000, possibly to 16,000, and then flag out. There is a potential that we could see it come down here and then get a nice pop back up. So ideally, the 16,000 to 17,000 area, retesting this low is highly likely. Retesting the 17,000 area is highly likely before we're going to see any type of potential upward move. I would say this potential upward move would be a very big speculative move. It may not last above this level here, but my modeling system says there's a potential for a move up above this level, which is 32,000. Hypothetically, there's a potential for a move up into that area. But in reality, ladies and gentlemen, we've got a much stronger probability of a move down below 17,000, 16,000 in Bitcoin, possibly below 12,000 before we see some sort of an upward move. Now, let's take a quick look here at the NASDAQ. NASDAQ has been fairly interesting. I'm going to show you how the predictive modeling system works. What we start doing is we start looking around key reversal areas, like right here. Right here, we got key reversal areas back over here. And I'll go one more. Okay. So what this is showing us, the predictive modeling system maps out price and technical DNA and tries to show us what is likely to happen. You'll notice if I spread this out, there's been a fairly clean observation from here across these downward trending cycles, upward trending cycles, and then back here to downward trending cycles. So these predictive qualities here have been fairly solid moving forward. But now we get into this divergent range. So what does this mean when we have divergent ranges here? This means that there are two likely outcomes that's going to happen. Number one, we could see this continue to melt lower, roll downward, potentially down into this area, or continue to roll kind of like this into this area. Ideally, this is an outlier. This trend down here that comes like this, that's a real outlier trend. That could happen. but it would become a price anomaly. And that's what's telling us here. Now we have the other scenario for the NASDAQ, which is we find some consolidation back in this area and potentially move back up into this area. And ideally that could happen in this environment. We would need to see this qualify. So how would we determine this as a qualification? This is daily, a daily chart. How would we determine this qualifier? I would tell you that we need to get above this previous high here. Oop, wrong one. We need to get above this previous high pretty much in that area, that yellow line, which I will try to highlight, make it light cyan. Try to make sure we got this set up right. We need to get above that previous high area before any of this can start to qualify. Right now, below this high, this downward trending, this downward rotation has got the most highly likely outcome, and this would become an outlier. If we were to see the NASDAQ break downward and get below, let's call it this level right here, actually probably this level, within the next 4 or 5 days, so it would have to break down in this window. So hypothetically, in this window here, it would have to break down below this 12,900 roughly level, break down substantially down into these areas, then this outcome becomes highly likely. And this basically becomes a scenario of, think of it as a progressive odds outcome. You know, how likely is it that something is going to do something in the future? Call it 6 moves or 8 days, 6 to 8 days out. Well, that actually depends. Given where we're at right now on the NASDAQ, this is most likely to be the outcome following this trend line going downward, simply because that's what it's doing already. If it does not deviate from this trend, it's likely to move downward into this area because it's already doing that right now. In order for it to move into this direction, we would have to see something break this trend and move the probability of up into this area. 1 day up into this area would maybe give us a 20-25% probability or odds that this is going to continue. 2 days up in this area would maybe increase it up to 30-35%. 3 days up in this area would maybe move it to 55-65%, because now we're seeing the actual follow through of price to qualify into this area. Same thing with this move. We would have to see it move down in this area 1 or 2 days. This would be a very big breakdown. And then I would tell you that, yep, we're getting from let's call it a 4 to 6% odds of it likely to move down into this area. If we did get a big breakdown for 1 or 2 days down here, then I would likely tell you that the odds of it staying down in this area and following this trend channel are probably somewhere around 45-55%, given the fact that it has done this, it has broken through this channel, and now we're away from this channel, broadly away from this channel, which would only have a 1 or 2% chance of actually doing anything. This would maybe be a 20 or 30% chance. This would now be a 30 or 40 or 50% chance, because prices moved into these channeling scenarios. So now, just for the heck of it, let's come back over and take a look at the ES. We're going to do the same thing. We're going to look at the same type of time frames. We will go here, 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 and across these tops. Okay, so now, the ES is predicting a vastly different scenario than the NASDAQ. The NASDAQ was weakening down into trending, whereas the ES is showing consolidation with the high likelihood that it may try to move higher. We do have a potential dip in place, followed by a recovery, followed by a potential dip. And then we have this outlier area right here, which may be a very deep selling pressure or a very deep downward dive around early September. So right now the S&P is telling us that it's very likely that we could see a recovery to the upside somewhere before the end of the month. We do have this downward trending here around 4,000, 50 roughly to contend with. And this could be a downside target. So my interpretation is that we are going to likely see some downward activity around this area, followed by upward activity, followed by a potential deep dive, and then back up in this area. That's what I think this modeling system is trying to show us. Predominantly, it wants to try to move higher, but we have some weakness taking place here. We know that we have some deeper downward trends with earnings coming up through the end of next week. And I see this as wanting to kind of roll a little bit lower, potentially stalling out around 4,100, 4,160, potentially making a deeper move into the 4040, 4050 area, then recovering into the end of the end of August, and then in early September we have this potential for a deep dive, which could be a very odd price anomaly. Maybe a Fed move, maybe some global contagion event, but this is telling us we have a price anomaly that could set up over here. Now let's take a look at the longer term picture here. So now when you take a look at this, does this look like it's unlikely? Does it look like we could see this roll over here and potentially flag out a bit? And remember, we still have that trend in the SPY coming across these highs that goes pretty much right across here. So understand that if my modeling system is correct, it wants to try to move higher based on biasing, but it's likely to try to stall out in this area, maybe pull back a little bit before it attempts to move higher. And that's what the predictive modeling system is attempting to show us. So now I've gone almost 50 minutes here. Look for my updates. Let's see how this plays out. We're going to stay cautious. Follow me on Twitter. Follow me on YouTube. Share my research with your friends. Let's see if we can make some money this year. Right now, we need to stay very, very cautious. Think of it as we are protecting our eggs. We're not being very aggressive. We're going to prepare for what may become a deeper downside move, particularly in the technology sector and the speculative stocks, the innovative ARK funds and things of this nature. But the end of the year might be really kind of a slide into nowhere. And that's what we need to be aware of. At the end of this year, the next 4 or 5 months may just slide into a very ugly downward trend going forward. Okay, that's it for now. Talk to you later.